Well, good morning. I am back in Springfield, Massachusetts, walking Naya. Hi, Naya. Say hi. So I just got back not too long ago from Texas. We went to the Limitless Conference, which was honestly, just kind of spoiler alert, awesome. So I went there with a couple friends that are also fellow investors with me, and it was eye-opening. I wanted to kind of share some of the stuff I've learned from those that are, higher than us. And so kind of wanted to talk about this in this video. And you guys have any questions or whatever, definitely leave them below. Try to answer them to the best of my knowledge. There was, once again, people that were there were far smarter than I am. I just want to kind of go over what I took out of the conference and what I'm learning and the action steps I'm taking with my company and my investments. And hopefully you guys can learn something from it as well. And hopefully get prepared for what might be in the next couple years or so to take advantage of. So first off, I've been to other conferences before, and specifically like BRRRR, which while I love BRRRR, I love the show, the conferences has always been pretty well. A lot has changed, and I definitely think that BRRRR, at least in general, is for someone just starting out. It's great. The speakers have been pretty darn good. They definitely give some good tidbits, advice. You don't generally get to meet people as often as far as meeting the actual speakers. I found there was much more access to the speakers at this conference, and I didn't even have the VIP pass, so to speak, but people were pretty accessible. I got to talk with Robert Kiyosaki. I didn't get to talk to Ken McElroy. I would have loved to. But AJ Osborne, Jay Scott, George Gammon. There's a lot of people that were very accessible. Brendan Turner was actually awesome, chatting with him in the gym. So thanks, Brendan. That was awesome. Brandon Turner. The general concept and kind of like an overview of the conference was, we are going into a downturn. Or we already are in a downturn. So for the most part, that was a general theme across the board. And while this was not just a real estate conference, there was definitely a lot of real estate investors. But there was other things there to learn about, like oil, gold. There was some cryptocurrency stuff, and there's some other, other investment. But in general, a lot of the people there, if not all the people there, were at least invested somewhat in real estate. And obviously, it's a real estate channel, and that is my focus. So I want to take away what I learned from that aspect and where I'm taking our portfolio. So the trend basically that was kind of reverberated throughout the conference was that we are entering into or not in a recession, that rates are possibly going to trend down for a little bit, but we're at the end of a rate cycle, and typically then at the end of the 40-year rate cycle, rates will start trending back up. So it might, kind of dip down and then go up. So what does that mean? It means that there's probably going to be a good opportunity in the next, I don't know. They didn't, no one was specifically saying exactly when, but let's just say the next 12 months or so. So 2025, for the most part, might be a good opportunity to find properties and lock in some lower rates. But the key really, just like any way we talk in general, is that now more than ever, it's just finding really good cash flowing properties and kind of sticking that out. That you're really not going to focus on looking for appreciation deals. You want to definitely try to also possibly find opportunities in niche markets. There was some interesting niche markets, EV chargers. There was talking about Amazon parking lots as rental ideas. There was quite a few other things that we're talking about now. The other thing, Ken was talking about how he just locked in a really good deal for a large multifamily. So Ken is looking obviously to buy, and he's talked about in his videos, buying quite a bit of real estate in the next, I think 18 months, he said. And so he's already, putting his money where his mouth is. They haven't closed on a deal in a while, and they just recently closed on that large multifamily. The big thing that they were talking about, though, is locking in lower rates As of now, he just locked in 5.75, I believe he's talking about. Now, this is agency debt. So this is one of the first things that I took away from this. Now, this isn't for the average investor. I would say this is for properties that are probably 2 million plus, because there are a lot of fees with agency debt, but it does tend to make things really advantageous. And I should do probably a video on just agency debt. And honestly, I haven't done an agency debt deal, but I am now, after doing this, I'm going to work on taking the time to work one of our apartment complexes and getting it refinanced, because we have about 2.5 years before the balloon is due, or it just starts adjusting. And so after kind of hearing what they're talking about agency debt, and I typically work with just DSCR loans and banks, it was really intriguing, because I kind of did a little more research into it. While they just kind of give you the highlights in the conference, I was able to kind of look into it a little bit more. And so agency debt is basically Fannie Mae, Freddie Mac, HUD. You can get, generally for these larger properties, you can get lower rates than you would at a typical bank, because you're looking at government loans. This is also typically fixed. So this might be fixed for 30 years or even 35 years on some of them. Now, that's not typically what you see for, say, a DSCR loan. You're looking at maybe fixed for 5. In the heyday, it was 10. And you would then have amortization of maybe 25 years. So this obviously is very enticing, especially for cash flow investors, because you can kind of get into a property and basically, really maximize cash flow by extending the loan out, generally a little bit lower rates. I also found, was that it's typically, you need 80% residential. So for instance, our mixed use property that we're talking about, it doesn't exactly meet the criteria, so I gotta learn about that. But I'm gonna talk about a whole nother video. I'm drumming on, sorry. But this was one of the things that I learned away from it, that is an action step that I'm taking right now. Talked to someone just yesterday to start working up the paperwork to do some agency debt on that property. So one of the other biggest things to take away was, now more than ever, is not to pack your pro forma. I think Tall Yarber was talking about that specifically. And while this is what I've been saying for a while, I 100% agree. Right now, don't anticipate the same growth necessarily over the last couple of years when you're working on evaluate or underwriting a deal. If anything, possibly take consideration stagnant growth, or maybe in a slight decline depending on your area, and put that into your pro forma and make sure it pencils out so it still cash flows. If it doesn't, it's probably not a good deal. So you're really looking for home run deals right now. And I can kind of talk to you about one that we actually had put just under contract right before the conference. And it wasn't, it wasn't a home run, but it was sandwiched between a couple other larger mixed use properties that we own. So I was like, all right, it's right there. I liked having it owning one block. So kind of having like the 4 green houses. And they're actually not, it was 13 unit buildings, but to get the red hotel, so to speak. So Monopoly style. But it wasn't a home run. It was a decent deal. We were also leveraging owner financing. And so that's why I was kind of intrigued by it and thought it would be a good deal. Unfortunately, the owner, for some reason, thought they were having their owner financing in first position. But we were very clear that we were getting a bank loan for some of the rest, and so they would of course have to be in second position. They didn't like that idea, which is fine. Honestly, after going to conference, it wasn't a home run. It was there was some value add, but not a lot of value add, and honestly, it was another project, and I think I am pretty happy that it is going to not go for us now. If maybe they reduce the price or willing to do more owner financing, the structure is a little bit more advantageous to us. In, who knows, 6 months, if they're still on the market, they'll come back. I don't know. We'll see. The other thing I do know that is a great zone for grants and stuff like that I've gotten before. So that's why, another reason why it was kind of enticing. But back to what learning from the conference, this is a deal that is not a home run. This was maybe a single. And so where we're going, I'd rather focus on, at least triples. And yeah, I usually don't do baseball metaphors, but yeah, it fits. So that's kind of where I'm at with that one. So that's another big thing, not packing your performas, not letting agents that are trying to sell you some deals. I actually got quite a few deal emails from Horvath and Trombley, Crexy and stuff like that, that just really packed. And actually, I'll talk about that. There was a deal at the conference. So someone spoke and they were talking about these different rentals down in the South that they do. And they're basically a developer that was able to get and lock in with a bank at really low rates transferable to new homeowners. So and they were at 3.75. So it's like, which I'm going to do a review. I will do another video on one of those deals. It might just be a short form video, but just one of the reviewing, because I got a couple of their deals at their table. But while awesome, right? 3.75, I think it was fixed for 30 years. Very enticing in that aspect. But what they did was they just packed the whole thing. So they basically pushed the price up drastically. So you still made almost no money. I mean, the cash on cash return was a sub 4%. And then that wasn't even including management and some other fees. So basically you're making less than a CD for taking on the risk. Now, of course, you maybe have appreciation, then you need some tax benefits. So there are some maybe internal, rate of return might be okay, but like not a deal that I think most people should even engage in, especially when starting out. That's just too risky. So that was one of the kind of deals at the conference that was offered. The other thing that was kind of take home from the conference is no one really knows, obviously, where the market's going. I have no idea, but it's now time to be prudent, take your time, do your research, line up and talk to a lot of lenders and make great connections like we've talked on this channel before. I think that's just good in any market cycle, is having good banking relations and having right now cash on the sidelines or lines of credit to be able to take advantage of the deals that should be coming, while it doesn't look like residential will be kind of hit really hard. So that might actually, depending on where we go with the election and everything and the policies that kind of get put in place, but residential for the most part might be kind of stagnant, might go up slightly. So flipping might be okay still for a while since there's such high demand and so low supply. I don't see them too many foreclosures coming for that aspect, but the 5+, maybe even some of the 2, the 4s, multifamilies might be opportunistic. There's this extend and pretend with banks. Looks like it's getting closer and closer to an end, and might be opportunities. Now there's some like crazy opportunities these guys were talking about that I am not even touching yet, where they were getting, 50 cents on the dollar or whatever for some of these massive, $100 million, $150 million deals. Not there yet. I'm not even sure if I ever want to get there, but that was kind of some of the crazy stuff they were talking about. But that's really kind of my takeaway from this, is focus on cash flowing deals, building relationships as always, tightening the ship, so to speak, as far as operations for my company, and get ready to take advantage at least in the next year, probably 2025, maybe early 2026, and then kind of just ride it out and see what the other cycle is. Now, every market's going to be different. So for instance, keeping in mind what's going on and policy changes that might affect you. So for instance, in Massachusetts, the Affordable Housing Act that just got passed recently, there are a bunch of things in there that I'm trying to tease out and see how they're going to affect and possibly to be able to take advantage of for growing our rentals / possibly also just adding more housing inventory locally, and just trying to figure out. I actually talked to the building commissioner locally, trying to figure out how they're going to implement them, and so kind of learn from that. So kind of learn and understand what's going on policy-wise, so that will be able to help your business grow or your investments grow. So kind of keep an eye on that and go from there. hope this was helpful. Now, it was a great conference. I don't think I'm going there next year, but I'm looking forward to more great financial conferences, and hope to see you guys there sometime. And definitely, if you do, come up, say hi. I love to say hi and see how everyone's doing and see what you guys are doing with your investments. Thanks a lot.